on funds transfer pricing, and today I would like to cover elements of the FTP framework, and then we start diving in, in the construct of the FTP, the building blocks, what is the TLP, what is the base curve, FTP curve. So let's start going slightly in details. So first of all, I would say there are 4 elements of FTP which construct FTP framework. And those elements are very important because, as I said, it is the whole process. It is not only one thing, FTP. So we have FTP landscape. By FTP landscape, we consider all products which represent the source of liquidity resource. For example, liquidity cost, liquidity benefit, liquidity value. So all products, both on the banking book and on the trading book, plus, as I said, all off-balance sheet transactions represent the costs of liquidity for the bank, and therefore they have to be FTP'd. So we have, like term liquidity premium, which we covered during the last session, which is TLP, and is related to the consumption of liquidity over the period of time. So as we said in the previous session, the product which consumes liquidity for longer will be charged the higher FTP rate under the normal upward slope of the interest rate curve. Similarly, products which are driving the need for the liquid asset buffer, so some portion of HQLA which has to cover this particular product. And for example, we are talking about NMDs, non-maturing deposits. We are talking about commitments. We are talking about credit lines. We are talking about liquidity lines. We are talking about, time depot with some portion of rollover, and we need to assume which portion goes out, which portion is going to be rollover. All those which, with the stochastic cash flows, this is something which we are covering always under liquidity course when we are referring to the stochastic cash flows versus deterministic cash flows. And in this case, we have liquidity buffer. Then we are talking obviously about trading book, which we have the transactions, and this will be covered in the subsequently in the future. We also need to allocate the correct FTP rate to the product and the trading book. So not only banking book is subject to FTP rate, but also trading book. The second element of the FTP framework is FTP methodology. And by methodology, we consider, all allocation, how we construct the FTP rate. So do we charge, so what building blocks are there? And I'm going to show you those building blocks. So, do we have an additional premium allocated to the product, to this particular product? Do we also charge for, the pipeline prepayment potential rate? So the fact that products can will be early withdrawn, repaid, and withdrawn on the liability side. So we have to allocate this additional spreads. And prepayment, OLAB, there is some products, are driving those additional costs and have to be allocated based on those additional costs. Plus, on the top, we will be speaking about this in a minute, we have something which is not considered FTP. So let's come back to the first slide when we were covering the elements of the FTP framework. We said methodologies. And in the future sessions, I will show you exactly, for example, how to price the NMDs, non-maturing deposit. it is quite, complicated because we need to allocate, not complicated, but we need to allocate both the charge, the liquidity component plus the base rate component to allocate, non-charge, but allocate. And there are also other like loans, revolving loans. We have some particular methodology, which is described in the FTP practice guide or is written in the FTP policy, how we price those products. So the methodology is very, very important. Usually determined, share with all FTP stakeholders, and discuss, socialize, because FTP cannot be taboo. It has to be transparent methodological process, how we calculate those FTP rate. And everyone who is involved or who is impacted by FTP has to know what is behind the methodology and how it was constructed and why. So this is methodology. The third thing is the FTP curve. And FTP curve is quite, probably one of the most important elements in the FTP, because it's such, a difficult process to find the curve which work for our bank. So it's not one size fits all exercise. Finding the right FTP curve is based on the particular situation of the bank itself. What are the objectives of the bank? Plus, on the top of this, what is its strategy? By strategy, we mean commercial strategy. So which product we want to incentivize, which product represents the strategy for the bank, which products are, let's say not so strategic. They are present on our balance sheet, but they are not considered strategic. And there is also the aspect of what is the composition of our funding base? Are we funding through deposits, retail deposits? Do we have access to capital market? Do we fund our balance sheet also through the capital market? And if so, this will be reflected in the FTP curve construct. So again, very tailor-made exercise, and we will go through FTP curve construct in detail. And the last one is the target operating model, because it is such emotional process within the bank, impacting the P&L, between the different business units, plus, allocation mechanism. We need to make sure that there is sufficient amount of robust controls in place, and transparency and explanation provided. So this is all, some kind of how we make sure who is doing what are the responsibilities, so that there is no conflict of interest. For example, if Treasury is in charge of the methodological framework for FTP, then Treasury cannot be responsible for, for the FTP documents, such as FTP controls and checking calculations of the FTP performance, because and also cannot be at the same point the business unit. Because if you have the business unit set up as Treasury, set up as the business unit, plus on the top of this, it is responsible for FTP. We already discussed that during the session 2. It is not the optimal setup, because it's subject to the conflict of, or can generate the conflict of interest, and could be challenged subsequently by the regulator. So target operating model, again, is the set of government's policies, a government's framework, who is doing what is the responsibility of different departments, who is responsible for methodology, who is responsible for the controls. and how the communication process looks like. Everything is described under this target operating model. Okay, as I promised, let's go into detail. Let's start driving a bit in detail into the FTP process and FTP framework. So FTP rate is composed of building blocks. So it is like small, imagine this is like small spread, which is covering each kind of risk, which is transferred from the business unit to the central unit. And all components of the FTP rate, so there are at least, 3, 4, or at least 3. It depends if you are charging, incentives. You are allocating incentives also under FTP framework, or you are charging some, optionality spread. This all is included under FTP rate. So first of all, you have the base component, which is like telling you how interest rate risk is transferred, on what basis. So if you have a 5-year product, fixed rate product asset, which have the interest rate risk because it is repricing within the next 5 years, the repricing frequency will be proxied by swap curve, and you will allocate the swap curve 5-year tenor as the FTP base rate component. Similarly, if you have, amortizing loan, which has, some portion repricing within the next, 1 month, another one within the next 2 months, and so on and so forth, and the last one within the 10 years, of course, you have to calculate the one overall rate, which is based on those repricing, because if it's fixed, then you have to calculate the average, what is the duration of this product, and the FTP component for interest rate risk is based on the duration of this product. So if you have the amortizing asset, which amortize over the fixed rate, which amortize over the period of 10 years, with the capital repayments over the next, 1 month, 2 months, and 3 months, up to 10 years, then you will calculate the duration of the product to understand what is the average, repricing tenor of this product. And the average repricing tenor of this product could be, in this case, let's imagine 5 years. So you will be allocating on the FTP interest rate risk component the 5-year swap curve tenor. Another example, imagine floating rate product repricing with the 3 months frequency. So every 3 months the product is repricing. So the interest rate risk is transferred based on the 3 months repricing. So you will allocate the 3 months swap curve, or whatever is your benchmark for, benchmark your OIS curve or your Euribor 3 months, and you will transfer the interest rate risk component based on this repricing frequency. The second component, which is put in place to transfer the liquidity risk of the bank, of the institutions. So it is representing the own credit riskiness of the bank itself. I will explain why. Imagine you have your funding composed of bonds issued in the capital market or bond market. What do? You will be obviously your market will price those based on your rating, based on your score. You know, what is your score according to market? And if you have high risk allocated by the market, you will need to pay more to investors, to people who invested or institutions who invested into this bond because of the riskiness or the perception of the riskiness which is embedded in your financial institution. So let's compare one bank of small size and another bank, which is high street bank, well known in the in the country, well known internationally. Of course, which bank will have to pay more for funding? The smaller one, because the smaller one needs to prove itself in the market and needs to gain the reputation and also prove profitability. Meanwhile, the high street banks are obviously there for many years. They have loyal customers and they don't need to pay so much for the funding in comparison to the smaller bank. So this component, which is taken from the FTP curve, and we will talk about this in detail, how to construct each. It is just to give you the understanding of those building blocks. So this component is reflecting the riskiness of the bank itself, not the riskiness of the customer. This is very important. Of the customer, I mean in terms of asset. For example, the final customer who is borrowing the money from the bank. No, this is the riskiness of the bank itself, of the financial institution itself. So the higher premium, liquidity premium, you have to pay in the market or in deposit market, you will be charging higher FTP to your assets. And of course, this is the natural consequence of the fact that assets are consuming liquidity, and the cost of this liquidity for particular tenor is given or provided by the FTP curve, estimated by the FTP curve. And if we have to pay more in comparison to high street bank, then of course the spread component of the funding, spread component of the FTP rate will be higher. And this is very important also in terms of of the allocation to the liquidity value, also through the different funding sources, because the cheaper the funding source, then the higher FTP rate, which is recognized to the liability. But we will be talking about this in detail, so I don't want to diverge from the main objective for today. So this is the second component. The third component, which sometimes people are, I heard different opinions. Sometimes it is not considered the, the FTP rate component, because it has to be calculated separately and allocated. But sometimes you do something which is known behavioralization of the product, and you automatically allocate this cost of contingent liquidity into the FTP rate. So sometimes it is charged separately, so not included in the FTP rate. Sometimes there are techniques which will go in subsequently. We will analyze those techniques, which are known behavioralization, and you include in the FTP rate also the fact that this product is consuming contingent liquidity, or driving the contingent liquidity cost. So you know that when the rates are high, then you have good probability that it will be positive cost of carry, because the liquidity which you need to allocate under the liquid asset buffer will be remunerated at higher rate than the cost of funding this buffer. But in the lower rate environment, it is just the other way around. So you are running the negative cost of carry, which means that this is expensive to hold liquidity in the form of liquid asset buffer. So you have to obviously charge this cost to the source of liquid asset buffer cost. And finally, we have the component which is, or bonus or malus, so some kind of incentives, which are in some cases included in the FTP to drive certain behavior, or to focus and to gain, more volumes of the certain product. And this is kind of incentive scheme. Incentive scheme is exactly recognized to the certain product additional, or you are, because if asset, then it will be negative because you will be charging them less. If it's liability, it will be positive because you will be recognizing them better rate. So this incentive component is basically for balance sheet shaping. So if we want to drive certain behavior, then it will be done through this component. So these are minimum elements which are included in the FTP rate. So the FTP rate is composed of those elements. Then you have components which are not considered FTP, which are not part of the funds transfer pricing scheme, which are cost of the credit risk. So you know that assets which you originate on the balance sheet, they have they are driver of the credit risk. So expected loss, unexpected loss, because of course the customer itself has different credit worthiness, and some customers unsecured loans can be more risky than other loans, and then we have to price it accordingly. There is also cost of this product, of the channel, commercial network, of people who are advertising the product, all other costs which are included in the origination of the product, and of course has to be priced out. And on the top of this, you have, this kind of margin, net margin, which you want to get. So, the difference between all those costs and FTP and the all-in rate, so external rate to the customer, because FTP component plus those components which I mentioned, they are not FTP. Both two segments forms part of external customer pricing, which is called all-in rate. So the customer rate, the final rate. And when you price the product, you will be having the base FTP as the, first component of the pricing. You have to know FTP, and then on the top of this, each product will have its own, credit risk assessment. So the cost of having the credit risk exposure, which is of course included, and for each asset class there is different cost from the credit risk perspective, plus also the cost because of the channel. Is it the direct channel? Is it the broker originated product? And eventually you want to have the final, final profit, which will form part of your P&L.